Hello everyone. In this session, we'll explore an essential but often overlooked dimensions of an embedded system engineering, that is financial feasibility. As engineers, we are trying to design the circuits, develop the firmware, and optimize the performance. However, in the industry, a product does not succeed because it is worked well. It succeeds because it is economically viable. Today, we will examine how the financial analysis tools such as break-even analysis, net present value, internal rate of returns helps us to determine whether an embedded product should be even built. Okay, let's dive into it. Before we begin, let's begin with a question. Why do we technically strong product fails? Many products fails due to the many products fails not only because of the poor engineering but because of a weak economic planning. The development costs are high, certifications are expensive, manufacturing margins are tight. If the revenue does not exceed the cost within the reasonable time, the company collapses. Regardless of how good the product is, the engineer excels without the financial feasibility leads to the failure. And this is why understanding the product economics is critical for embedded engineers. By the end of the session, you should be able to define the key components of economic product economy, calculate the break-even analysis for the embedded product, analyze how the cost change affects the financial risk, evaluate the investment attractiveness using NPV and IRR. Notice that we are moving beyond understanding into the calculation, analysis, and evaluation. Higher levels of thinking is required in engineering discussion making. So let's start with a quick thinking question, right? If the development cost of $100,000 a product is made of it and you are making a $20 profit per unit, how many units must be sold before you began to make a profit? Okay, just do a quick calculations. Till now, we had been seen with some particular formulas and all that stuff. If you're good with it, you can able to make it out. Otherwise, don't worry. We are going to come back and solve the formulas, right? The formula will be soon discussed. We'll discuss while confirming the answer is. What is the answer? Anyone? So that will be a 5,000. Sorry, no, 50,000 products has to be sold together. This illustrates the fundamental logic behind the break-even analysis. As we move forward, we'll understand what are the important. Before calculating anything else, we must understand the product economics as a system. There are six key components what we need to understand. The first one is the development cost, that is the fixed cost of R&D, prototyping, certifications, and tooling. The next one is manufacturing cost, the variable cost per unit. So like the uh, components, the change of variables and all the things comes into it. The selling price, what the customers are willing to pay. The market size is nothing but potential demand, what's there for the product. Profit margin, the difference between the price and the cost. And finally, the risk, that is in technical, market, financial, and the supply chains uncertainty. The economic viability can be summarized simply as the market demand multiplied by the profit per unit must exceed the development and operating cost. If that inequity is not satisfied, the product is not sustainable. So now let us formalize this idea. The break-even quantity is calculated as the fixed cost divided by the difference between the selling price and variable cost In other words, the break-even analysis equals to the fixed cost divided by contribution margin. Okay, the break-even represents the survival point. At this point, the total revenue equals the total cost. There is no profit and no loss. Every unit sold after the break-even contributes directly to the profit. Let us apply this realistic to an embedded product. Suppose a development cost is $80,000 as we see in here, right? And the selling price is $70 and the manufacturing cost per unit is $32. So the first we need to calculate profit per unit, that is 70 minus 32, that is $38. All right, the next one is we need to find divide 80,000 divided by 38, that gives you the break even. This gives approximately 2,106 units. That means the company must sell at least this amount of units net before generating a profit. If the total market demand is 5,000 units, the project appears viable. If the demand is only 1,500 units, the project will fail financially. So already we see how the engineered discussions depends upon economic forecast. So now the another one is sensitive analysis. Now let us increase the complexity. Okay, what happens if the manufacturing cost rises from $32 to $40 due to the supply chain shortage? Now the profit per unit becomes 70 minus 40, that is $30. The break even become, to calculate the break even, that is 80,000 from the previous slide what we had seen it, divided by 30, that gives you 2,667 units. It has been a quite increase from 2,106 units what we had previously calculated. So notice what happened. A small increase in the cost caused the break-even to increase by more than 500 units, approximately here and there. This is financial sensitivity. Now, we'll pause here for a minute and we'll think about the different things. Would you still invest in this project? What risks have increased? Think it. This is where the engineer begins thinking like decision makers rather than just designers. There are something else like beyond the break-even analysis. The break-even analysis ensures that the survival, but the investors are not interested in survival alone. They are interested in value creation. In value evaluating the investment attractiveness, we use the net present value or NPV or return on investment ROI, or the next one is internal rate of returns, simply called as IRR, and payback period. These metrics count for the time value of money, capital cost, and long-term profitabilities. So let us analyze by considering a simple scenario. Initial investment is $120,000. The annual sale is 3,000 units. The profit what we attain is 38 per unit and the discount rate is 12%. Now, using the discounted cash flow analysis, we obtain the NPV of approximately 2,180 2,180 2,000 $218,870 and an ROI of 291% and IRR of 63%, and the payback period is 1.28 years. Since the IRR is significantly higher than the cost of capital, the investment appears financially strong. This is the type of evolution ventures capitalists performs before investing. The risk and project controls. However, the financial success depends upon managing risks. Embedded product faces technical risks, that is, design may fail, the market risk, the demand may get lower as we predicted, lower than predicted, like you had made some customer survey and you predicted like the demand is more, but the market, we don't know about the market may get lower than we predicted. The supply chain risk, the component may become unavailable or it may get a problem in supplying it. As we see, there are different things happen globally. The regulatory risk, the certification may be getting delayed. To monitor the execution, the project managers use a performance metrics such as cost perform index, that is CPI, and schedule perform index, that is SPI. If the CPI is less than 1, the project is over budget. If SPI is less than 1, the project is behind the schedule. The financial controls and technical control must operate together. As we move to conclude with an financial calculations, if a cost is $200,000, the selling price is $80 and the variable cost is $50. What is the break-even quantity? So to calculate the break-even quantity, that is nothing but the fixed cost divided by the selling price, the difference of the selling price minus the variable cost. That is around 6,607 units. This contributes the margin of $30. Dividing that, now what we reflect from this, if the market size is only a 5,000 units, should this product should be developed or not? No, if your product demand is only 5,000 and you want to earn the profits, then you need to go beyond 5,000. But that's the break-even analysis, but the market is 5,000, then it will not be done. This is the level of thinking expected from the embedded systems engineer operating in industry. As we move to the final slides, what are the takeaways from it? What we learned from today is a break-even values determines the survival. The sensitivity analysis measures risk. MPV and IRR determines the value creation. The engineer discussions must align with economic feasibility. The best embedded engineer do not only design the circuit, they design sustainable businesses. As this, I conclude my session today. Thank you for your attention. If you have any questions, you can able to ask me. Thank you.